BDCs are popular in dividend portfolios because many yield close to 10% or more. I reviewed all 44 publicly traded BDCs and built a portfolio with every one of them to see how the income holds up, especially as interest rates come down. The headline yield looks good, but the income story had a few surprises. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. If you're newer to BDCs, they're companies that primarily make loans to smaller, often riskier businesses and pay out most of their profits as dividends, which is why their yields tend to be really high. I spent a number of hours this week reviewing data on each BDC, and it became pretty clear to me that some BDCs are definitely better positioned for the environment ahead than others. I'll touch on that at a high level today, but let's first look at the portfolio I put together. I'll be using our website, Simply Safe Dividends, to walk through this analysis. Our site includes tools for tracking income, evaluating dividend safety, finding quality income ideas, and a whole lot more. If you'd like to try the free trial, no credit card required, I'll leave a link in the description below. Here's a look at our All-BDC portfolio. I built it using all 44 publicly traded BDCs that I'm aware of, and I equal weighted them. They each are 2.3% of the portfolio's value. Despite all being BDCs, there's still some variety here. The largest one has a $15 billion market cap. That's Ares Capital. On the smaller side, there are some really small BDCs out there with micro caps of around 100 to 200 million. Overall, about half the group has a market cap below 800 million, so BDCs tend to be relatively small companies. Dividend yields have a pretty wide range too. The highest yielding BDCs throw off yields around 20%. Main Street Capital is the lowest yielding BDC at just a 5.1% yield, but they're all producing pretty good income today. That being said, their pace of dividend growth has slowed. In fact, of this group of 44, we're only seeing 5 of these BDCs that have increased their dividend in the past year. The rest have either kept their dividends frozen or in some cases cut their dividend, which we'll talk more about next. Now, overall, this portfolio has income appeal, right? The headline yield is 12.7% on a $1 million portfolio balance. That's good for annual dividend income of about $127,000 each year. The income is great right now. In fact, New Year's Eve, this portfolio would be looking at a payday of $5,600 from its holdings. And over the course of a full year, you can see how the income spreads out. And there's a few special dividends that are coming in as well. So most BDCs are paying on a quarterly basis. You can see there's a few monthly payers in here. But overall, it's a somewhat chunky, but just a very high income stream. Now, that's about where the good news ends, because over time, that income stream has not proven to be the most reliable. This chart here is showing you this portfolio's annual income only based on the actual dividends declared by all of these companies. So it's representing their true organic dividend growth rate. It's not assuming any money is reinvested or anything like that. And it's not been a great picture. Over the last decade, this All-BDCs portfolio has seen its dividends decline by 3% per year. If you look at these mini dividend growth charts, you're going to see some of these companies with pretty ugly trends in their payouts or some lumpiness tied to economic cycles. That's type of decay has kind of been true over all these time periods, including this year. The portfolio's dividends are trending to be down 2%. When you throw on, 2-3% inflation, your real income is not great from this portfolio. That 12.7% yield is a bit of an illusion. It's going to be declining probably around 4 or 5% on a real basis over the long run if history is any guide. Now, not every BDC is an anchor, but most of them are. This report looks at the portfolio's income stream through the lens of our dividend safety scores, which are trying to predict dividend risk over a full economic cycle. They've avoided 97% of dividend cuts since we started doing this in 2015 if investors stuck with companies that maintained safe and very safe ratings. Now, about 70% of this portfolio's income stream is coming from stocks with an unsafe or very unsafe dividend safety score. We expect most of these businesses to reduce their dividends over a full economic cycle. Only about 13% of the portfolio's income is from borderline safe payers, which have a better risk profile, but definitely are not out of the woods. And there's just one BDC that has a safe rating, that's Main Street Capital. So a lot of this doesn't paint a great picture either for the forward-looking risk to the portfolio's headline yield. And besides dividend cut risk, I want to show you this ETF BIZD. It's the largest ETF tracking BDCs out there. It's different than the portfolio we built because it's market cap weighted and it doesn't hold all 44. But the top 3 weights, Ares Capital, Blue Owl Capital, Main Street, are about a third of the portfolio's value. These are the larger, more liquid BDCs, generally higher quality as well. But despite that tilt, take a look at the index here with what happened to this ETF during the pandemic. So its value was cut by more than half. The S&P 500 was down about a third of that same period. So BDCs are pretty stressful investments to own when the tide goes out because investors worry about loan losses, what's actually in their portfolio. They take on a lot of leverage. Interest rates come down, reducing their income. There's a lot of headwinds that cause these to be very volatile stocks. So let's take a look now at some of the BDCs that might be better positioned for the future that could include rising credit losses and lower interest rates. Main Street Capital is the type of BDC you want to find if you're a conservative investor. It has a BBB- investment grade credit rating from S&P. It has a long history of not only safe dividends, but rising dividends, 14 straight years of dividend hikes. That includes the financial crisis, the pandemic, the 2015 oil crash. Very impressive track record. Few BDCs have that type of lengthy history. And the headline yield of 5% reflects Main Street's regular dividend, which is supplemented with these extra payouts, which bring the total yield above 7% today. So Main Street is careful not to overstretch itself with that base dividend, which has been important in recent years. Earnings have jumped a lot as interest rates were raised by the Fed in 2022. That helped a lot of BDCs' income because most of their loans have variable rates, but some of their capital they use to fund those loans carries fixed rates or is funded with equity. So that lift in earnings, Main Street was conservative by not lifting its regular dividend at the same type of pace, and that helped its payout ratio come down to around 70-75%. It's expected to remain just under 80% in the year ahead, which is well below its historic norm. So Main Street is doing a great job continuing to cover its dividend, even as the Fed has been lowering rates over the past year or two, and that looks set to continue going forward. So it has a strong balance sheet, time-tested performance, keeping that dividend intact throughout downturns, and its payout remains well covered. However, there's more to BDCs than some of those headline numbers suggest. I made a spreadsheet that pulled in a lot of industry-specific metrics that are really helpful for evaluating BDCs below their headline payout ratios and dividend streaks. So let's take a look at Main Street to show you what you want to try and find for a quality BDC. The first metric is price to NAV, which stands for net asset value. When a BDC is trading below its net asset value, the market is basically saying that its portfolio is worth less than what the company reports on paper. Investors want a discount because they see more risk. So you see some extreme cases like Prospect Capital here that trade at less than half of the fair value reported on their portfolio, just reflecting very low confidence in the quality of their loan book. Main Street is certainly a positive exception. They trade at a big premium to NAV, the highest in the space, 1.8 times. So investors really like Main Street's ability to manage risk, and they have a lot of confidence in the company's portfolio. Another factor I like to look at is operating costs. So this is measured as a percentage of a fund's net assets. Main Street has the lowest ratio at just 2.4%. The lower the operating cost, the more money that flows through to you as a shareholder, and the less a fund has to reach for risk to earn a reasonable spread with its investments. Now, the payout ratio we talked about, but again, worth noting that not only is Main Street's payout ratio solid at 79%, that's well below the 104% we're seeing across all these BDCs, which marks a jump compared to the trailing 12-month payout ratio of 98%. So some of these funds are definitely approaching what I would call the danger zone. It's not uncommon to see these dividends get cut once that payout ratio starts creeping up 110, 120%. Here's a list of those. FSK actually recently announced a big cut to its dividend effective in 2026, so that will be coming down once it's made official. But these are kind of the BDCs that I would view as high alert, red alert for their dividends. Now, continuing on, leverage is a big factor as well. We like BDCs that are conservative with their use of debt. A lot of the companies that they do business with also use high amounts of debt. So this is leverage on top of leverage, which makes them so volatile. We can see Main Street here looks great. It's using about half as much leverage on average as its peers. A leverage ratio of 1 means the company is borrowing $1 of debt for every $1 of equity that it has. So Main Street, very conservative. Their leverage target is also just 0.8 to 0.9 times. So they're well below that, they could always make more investments and up that leverage to help combat any reduction in their portfolio's interest income if the Fed keeps lowering rates. They have some flexibility. Now, another metric to look at here is non-accruals. These are loans that are not being paid. They've been moved to non-accrual status as a percent of the portfolio's total fair value. Across the whole space, about 1% of the portfolio today is on non-accrual status. Main Street's right in line with that. You can see some BDCs are seeing a much bigger share of their loans non-performing today when the economy is by most means stable and growing. So it's good to see Main Street there kind of sticking at a healthy level of portfolio performance. PIK is known as payment in kind. This is basically how much of a BDC's interest income is coming from non-cash sources. So they report all of it as earnings, but we want most of that to be cash. So lower numbers are better. Main Street here, just 4% of their total interest income is from payment in kind. Some BDCs much higher, and those are going to be, again, riskier sources of income that may or may not get paid. It could be a sign of distress, but Main Street's portfolio, once again, looks pretty solid. The final thing I'll point to is this NII change. That stands for net investment income. So for every 1% move the Fed makes in changing interest rates, how much does a BDC's net investment income change? This is all their interest income after expenses, like their own interest rates. And there's a big degree of range here with sensitivity. We can see on the low end, there's a few BDCs here that hardly see their interest income outlook change much when the Fed moves rates by quite a bit. In fact, Trinity Capital is 0%, whereas others will see big fluctuations, like SCM expects its net investment income to move nearly 20% for every 1% change the Fed makes to its short-term interest rates. Main Street is kind of middle of the pack to slightly less sensitivity, about a 6% swing. So not overly rate sensitive by any means. And again, I think that all helps gain more confidence and comfort with its payout ratio and ability to weather these cycles. So future video, I may dive more into this spreadsheet and share the safest and the riskiest BDCs looking at some of these metrics, but hopefully that gives you a flavor for how to evaluate these types of securities if you're interested in them for your own portfolio. So a portfolio of all BDCs isn't a great idea, but some of them can make sense in an income portfolio if you are selective and comfortable with their volatility. If you'd like help evaluating dividend safety or tracking your own income, you can try Simply Safe Dividends with our free trial. No credit card required. The link is in the description below. Thanks for watching, and I hope to catch you next time.